Over the past few weeks, we have seen many dividend stocks announce that they are increasing the amount they pay out in dividends. And if you know anything about dividend stocks, you know that dividend increases can really play a major role in causing the dividend snowball effect to take place. So in this video, we're going to be looking at 5 different dividend stocks that just recently announced dividend increases. And to get started, we have a big dividend hike coming in at 15.8% from Williams-Sonoma. So if we look at Williams-Sonoma over the past year, they're up close to about 5%, but have seen a bit of a sell-off in 2025, down 10.32%. And something I do always want to make note of, we can see short interest for this stock is quite a bit higher than I typically like to see it, coming in at 7.36%. So there are institutions actively betting against this stock. Now, if we jump over to the dividend breakdown sheet, let's come up here and plug in WSM. And like always, if you'd like to download any of my spreadsheets and also get access to the Ticker Data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now we can see Williams-Sonoma has a relatively low starting dividend yield, but this will be a little bit higher after the recent dividend hike. But the good news is they don't use much of their capital to actually pay out dividends, and as a result of this, they're able to grow their dividend at a very high rate, especially in the last 5 years. Look at this. A 5-year dividend CAGR of 18.2%. But even though they've been growing their dividend at a really high rate, the free cash flow payout ratio has actually been going down. And this is one of my absolute favorite things to see as a dividend growth investor. The only way your dividend growth rate can be really high, but the free cash flow payout ratio go down, is if you're growing free cash flow at an astronomical rate. And that's exactly what they have done. 5-year free cash flow CAGR of 22%. We can see it really took off starting in 2020, when free cash flow hit about $1.1 billion, and in 2024 it was about $1.14 billion. Now, if we look at the stock screener, let's go ahead and plug in Williams-Sonoma. A few things we do need to make note of is revenue per share has been a little bit stagnant over the last few years, but here's the good news. If we jump over to the profitability sheet, we can see the gross profit ratio has continued to increase over the last few years and pretty significantly over the last decade. 10-year average gross profit ratio below 40%, but last year's came in at 46.45%. So even though revenue has been a little bit lower over the last couple of years, we can actually see the earnings per share for Williams-Sonoma has continued to increase because the company has become more profitable. Next up, we have a stock in my personal portfolio, and that is JPMorgan Chase, and they just announced a very nice dividend increase of about 12%, and this is putting their starting dividend yield close to 2.38%. If we look at JPMorgan in the last year, up close to 24.36%, and year to date, currently up about 3.51%. Now, we have to remember, when we're talking about bank stocks, we don't pay as much attention to free cash flow. We want to pay attention to the earnings of the business. That's going to give us a much better idea of the actual sustainability of those dividends. So if we jump over to the dividend tab here on Seeking Alpha and click on dividend safety and scroll down, what we can see is the payout ratio, the earnings payout ratio, is only sitting at about 24%. And if we look at it forward looking, it's closer to about 29%. That's because if we jump over to our summary tab, we can see the earnings per share for the business is about $18.33, while the dividend they're paying out is about $5.60. So the earnings is easily covering those dividend payouts. On top of this, if we look at the earnings growth history for JPMorgan over the last few years, we'll jump over to the income statement and scroll down. Look at basic earnings per share. We've seen significant growth in this number over the past decade, and it's projected to grow at a healthy rate moving forward. Now we come to Dick's Sporting Goods, who just announced another double-digit dividend hike coming in at around 10%. And if we look at Dick's over the last year, they're down by about 11%, and year to date, down about 12.54%. Now I do have to point out, this is another stock that has over 7% short interest at 7.32%. So there's a lot of institutions actively betting against this stock. Now, if we jump over to the dividend breakdown sheet and plug in the stock ticker, what we can see is that starting dividend yield is around 2.31%. And if we look at the dividend history, we can see it's been growing over the past decade. But right here in 2021, Dick's Sporting Goods paid out a massive special dividend, boosting the 2021 dividend to about $7.10. So if we scroll down and just look at that dividend history, you can see right here is when that special dividend was paid out in September of 2021. Now, here's what's interesting about Dick's. If we look at the free cash flow versus dividends paid out over the past decade, what we can see is 2020 saw a huge spike up in free cash flow. And during this time, yes, they're still increasing their dividends, and the free cash flow payout ratio is only about 8%. But here's the problem. The free cash flow has been going down over the past few years, while the dividend payments has been going up. So what's the end result of this? Well, the free cash flow payout ratio has been increasing. It's increased so much that at the end of 2024, it was sitting at 71.03%. So in just a 4 or 5 year time period, the free cash flow payout ratio went from 8% all the way up to 71%. So those high levels of dividend growth are not going to be sustainable unless free cash flow starts to get back on track. Along with that, it is worth noting that if we look at Dick's Sporting Goods on the stock screener, we can see they've been buying back quite a few shares over the past decade. Next up, we have a smaller dividend hike from Qualcomm with a dividend increase of just 4.7%. And if we look at this stock over the last 6 months, down about 7%, and in the last year, down by about 5.2%. Now, at one point, this stock was trading as high as $227 per share, so it's down pretty significantly from its all-time high, definitely trading on the lower end of its 52-week range. Now, if we look at the stock from a dividend perspective, we'll plug it in. We can see they're currently yielding around 2.15%. They've been growing their dividend for the past decade with a 10-year dividend CAGR of about 6.2% and the 5-year closer to about 6%. So this most recent dividend increase is a little bit lower than what we've been seeing on average over the last 5 and 10 years. That is something worth making note. Now, why would that be the case when the 5-year free cash flow CAGR is as high as about 12%? Well, you have to understand one of the key points that's been going on with Qualcomm over the last year. Bloomberg News has reported that Apple will start replacing Qualcomm's modem chips this year, beginning with the iPhone SE. And Apple will have switched entirely to its internally built modem on all devices by 2027. And this plays a big role in the future projections for Qualcomm's earnings. For example, if we look at earnings estimates for the stock, we can see over the next year, it's still projected to actually be quite solid at about 15%. That is rapid earnings growth, but we see it drop off a cliff in the coming years. So the big question is, where are they going to find their growth outside of Apple? Because that Apple revenue is going away. And then finally, we have another lower dividend increase at about 4% from Colgate. Now, if we look at Colgate over the past year, they're up about 3.6%. And if we look at them year to date, up about 2.51%. And one of the things you have to understand about this stock is it is considered very defensive. Typically, people who are looking for capital preservation along with a slow growing dividend are going to turn to these types of stocks. So if we jump over to our dividend breakdown, let's come up here and plug in the stock ticker. And what we can see is we get a starting dividend yield of close to 2.15%, and the company uses around half of their free cash flow currently to pay out that dividend. Now, one of the things I do want to make note of is the dividend growth over the past 10 years, over the past 5 years. They've both been slow, just a little bit below 3%. And depending on the inflation rate you believe in, you could argue this dividend growth rate is below the rate of inflation, meaning technically they haven't been increasing their dividends, which is not something you ever want to see. But I will say with this most recent dividend increase at about 4%, it is a little bit healthier and likely above the rate of inflation. So there is a history of growing dividends, but at a slow rate. Now, the good news is free cash flow, especially in the last few years, has been able to climb to an all-time high, sitting at about $3.54 billion. It's also worth making note that the company did just announce they're going to be launching a $5 billion share buyback program. So it's really much more of a shareholder yield stock overall when you include the buyback yield and the dividend yield. But there you go, those are 5 dividend stocks that just recently announced dividend increases. Go ahead and let me know what you think of these stocks in the comments down below. And like always, if you'd like to download any of my spreadsheets and also get access to the Ticker Data add-on on Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.